The income statement, often referred to as the profit and loss statement, is one of the fundamental financial statements used in accounting and business analysis. Its primary purpose is to provide a detailed summary of a company's revenues, expenses, and profits or losses over a specific period, typically a fiscal quarter or year. The preparation of the income statement is not merely a mechanical process, but a critical exercise that demands accuracy, consistency, and a deep understanding of accounting principles. The statement serves as a mirror reflecting the operational efficiency and profitability of a business, offering valuable insights for internal management, investors, creditors, and other stakeholders. At the core of the income statement lies the concept of accrual accounting, where revenues and expenses are recognized when they are earned or incurred, regardless of when cash is actually received or paid. This approach ensures that the income statement presents a true and fair view of the company's financial performance during the reporting period. The process of preparing an income statement begins with the collection and classification of all relevant financial data. Revenues, which represent the inflow of economic benefits from the sale of goods or services, must be accurately recorded. It is essential to distinguish between operating revenues, which are generated from the company's principal activities, and non-operating revenues, such as interest income or gains from asset sales. Once revenues have been identified and measured, the next step involves the recognition and categorization of expenses. Expenses are the outflows of resources incurred in generating revenues. They can be classified into several categories: cost of goods sold, COGS, selling, general and administrative expenses, SG&A, depreciation and amortization, interest expenses, and taxes. Cost of goods sold represents the direct costs attributable to the production of goods or provision of services sold during the period. SG&A covers a wide range of indirect costs, including salaries, rent, utilities, marketing, and office supplies. Depreciation and amortization account for the systematic allocation of the cost of tangible and intangible assets, respectively, over their useful lives. Interest expense reflects the cost of borrowing, while income tax expense denotes the taxes payable on the company's profits. The structure of the income statement typically follows a standardized format, beginning with total revenues at the top, followed by the deduction of COGS to arrive at gross profit. Gross profit is a crucial metric, as it measures the profitability of the company's core operations before considering indirect costs. Next, operating expenses are subtracted from gross profit to determine operating income or earnings before interest and taxes, EBIT. This figure provides insight into the company's operational efficiency and its ability to generate profit from its main business activities. After accounting for interest and tax expenses, the bottom line, net income, is derived. Net income represents the residual profit available to shareholders after all expenses have been deducted from total revenues. In practice, the preparation of the income statement involves several steps. The first step is to close the books for the reporting period, ensuring that all transactions have been recorded accurately and completely. Adjusting entries may be necessary to account for accrued revenues and expenses, deferred income, and other timing differences. Once the trial balance has been finalized, revenue and expense accounts are analyzed and summarized. Supporting schedules, such as inventory records and payroll summaries, provide the necessary detail to substantiate the amounts reported on the income statement. The accountant must also ensure compliance with relevant accounting standards, such as Generally Accepted Accounting Principles, GAAP, or International Financial Reporting Standards, IFRS, which prescribe the recognition, measurement, and disclosure requirements for income statement items. One of the key challenges in preparing the income statement is the proper matching of revenues and expenses. The matching principle requires that expenses be recognized in the same period as the related revenues, thereby ensuring that the income statement accurately reflects the results of operations. This principle is particularly important in industries where revenue recognition may be complex, such as construction, software, or long-term service contracts. Accountants must exercise judgment in estimating the timing and amount of revenue to be recognized, as well as in determining the appropriate allocation of indirect costs. Failure to adhere to the matching principle can result in distorted financial results and mislead users of the financial statements. Another important consideration in income statement preparation is the treatment of unusual or non-recurring items. Companies may occasionally incur gains or losses that are not part of their ordinary business activities, such as the sale of a subsidiary, restructuring charges, or impairment losses. These items should be separately disclosed on the income statement to enable users to distinguish between recurring operating performance and one-time events. Proper classification and disclosure of such items enhance the transparency and usefulness of the income statement, facilitating more informed decision-making by stakeholders. The income statement also plays a critical role in financial analysis and performance evaluation. Investors and analysts rely on key metrics derived from the income statement, such as gross margin, operating margin, net profit margin, and earnings per share, EPS, to assess a company's profitability, efficiency, and growth potential. Management uses the income statement to identify trends in revenues and expenses, evaluate the effectiveness of cost control measures, and formulate strategies for improving profitability. Creditors and lenders examine the income statement to gauge the company's ability to generate sufficient earnings to meet its debt obligations. Regulators and tax authorities use the income statement to verify compliance with legal and tax requirements. In addition to the traditional single-step and multi-step formats, companies may present the income statement in various ways to suit their reporting needs. The single-step income statement aggregates all revenues and gains and subtracts all expenses and losses in a single calculation to arrive at net income. The multi-step income statement, on the other hand, provides a more detailed breakdown of revenues and expenses, distinguishing between operating and non-operating items, and highlighting intermediate profit figures such as gross profit and operating income. The choice of format depends on the complexity of the business and the informational needs of users. The process of preparing the income statement is closely linked to other financial statements, particularly the balance sheet and the statement of cash flows. The net income reported on the income statement flows into the equity section of the balance sheet as retained earnings, while certain non-cash items, such as depreciation and amortization, are adjusted for in the statement of cash flows. Consistency and accuracy in the preparation of all financial statements are essential to ensure the integrity of the company's financial reporting. Technological advancements have transformed the way income statements are prepared and analyzed. Modern accounting software automates many aspects of the process, from data entry and classification to the generation of financial reports. These tools reduce the risk of errors, improve efficiency, and enable real-time monitoring of financial performance. However, the reliance on technology does not diminish the need for professional judgment and oversight. Accountants must remain vigilant in reviewing the accuracy and completeness of the financial data, interpreting the results, and ensuring compliance with applicable standards and regulations. The preparation of the income statement also involves ethical considerations. Management may be tempted to manipulate revenues or defer expenses to present a more favorable picture of the company's performance. Such practices, known as earnings management, can undermine the credibility of the financial statements and erode stakeholder trust. It is the responsibility of accountants and auditors to maintain high ethical standards, apply professional skepticism, and adhere to the principles of transparency and objectivity in the preparation and presentation of the income statement. In addition to the statutory requirements, many companies voluntarily provide additional disclosures and segment information in their income statements. Segment reporting enables users to analyze the performance of different business units, geographical regions, or product lines, providing deeper insights into the sources of revenue and profitability. Non-GAAP measures, such as adjusted EBITDA, earnings before interest, taxes, depreciation, and amortization, are often presented alongside the standard income statement to highlight underlying trends and facilitate comparison with industry peers. While these alternative measures can be useful, it is important for companies to clearly define and reconcile them to the most directly comparable GAAP figures, ensuring transparency and consistency in financial reporting. The income statement is not only a historical record of past performance, but also a valuable tool for forecasting and planning. By analyzing trends in revenues and expenses, management can develop budgets, set targets, and allocate resources more effectively. Scenario analysis and sensitivity testing based on income statement projections help companies anticipate the impact of changes in market conditions, pricing strategies, or cost structures on future profitability. This forward-looking perspective enhances the strategic value of the income statement as a decision support tool. International differences in accounting standards can affect the preparation and presentation of the income statement. While the basic principles are similar, there are notable variations between GAAP and IFRS in areas such as revenue recognition, expense classification, and disclosure requirements. Multinational companies must navigate these differences to ensure compliance with local regulations and comparability of financial information across jurisdictions. Harmonization efforts by standard-setting bodies aim to reduce these disparities and promote greater consistency in global financial reporting. The income statement is also subject to external audit and review. Independent auditors examine the company's accounting records, test the validity of transactions, and assess the adequacy of internal controls to ensure that the income statement presents a true and fair view of the company's financial performance. The auditor's report provides assurance to stakeholders regarding the reliability of the financial statements and the effectiveness of the company's financial reporting processes. In summary, the preparation of the income statement is a multifaceted process that requires careful attention to detail, adherence to accounting principles, and a commitment to transparency and integrity. It involves the systematic collection, classification, and summarization of financial data, the application of judgment in recognizing and measuring revenues and expenses, and the clear presentation and disclosure of results. The income statement serves as a vital tool for assessing profitability, informing decision-making, and communicating financial performance to a wide range of stakeholders. Its importance extends beyond mere compliance, playing a central role in the management, analysis, and strategic planning of businesses of all sizes and industries. As businesses continue to evolve in response to changing economic, technological, and regulatory environments, the preparation and use of the income statement will remain a cornerstone of effective financial management. Continuous improvements in accounting standards, reporting practices, and analytical tools will enhance the relevance and reliability of the income statement, supporting better decision-making and fostering greater trust in the financial information provided by companies. The ultimate goal is to ensure that the income statement fulfills its fundamental purpose, to provide a clear, accurate, and comprehensive picture of a company's financial performance, enabling stakeholders to make informed judgments and contribute to the long-term success and sustainability of the organization. The preparation of the income statement begins long before the actual drafting of the document. It starts with the proper maintenance of accounting records throughout the reporting period. Every transaction, whether it involves sales, purchases, expenses, or other financial activities, must be accurately recorded in the company's accounting system. This foundational step is essential because the reliability of the income statement depends on the quality and completeness of the underlying data. Companies often implement robust internal controls and periodic reconciliations to ensure that the accounting records are free from errors and omissions. As the end of the reporting period approaches, the accounting team reviews all transactions to confirm that they have been recorded in the correct accounts and periods. Adjusting entries are made to capture any accrued or deferred revenues and expenses, ensuring compliance with the accrual basis of accounting. For example, if services have been performed but not yet billed, an entry is made to recognize the revenue earned. Similarly, expenses that have been incurred but not yet paid, such as utilities or wages, are accrued to match them with the corresponding revenues. The next phase involves the preparation of the trial balance, a listing of all account balances at the end of the period. The trial balance serves as a checkpoint to verify that total debits equal total credits, indicating that the accounting records are in balance. Any discrepancies are investigated and corrected before proceeding. The revenue and expense accounts are then analyzed in detail, with supporting documentation reviewed to substantiate the amounts recorded. This may involve reconciling sales invoices, purchase orders, bank statements, payroll records, and other source documents. Once the accuracy of the financial data has been confirmed, the accountant begins the process of assembling the income statement. The first section lists all revenues generated during the period. This includes sales of goods or services, as well as any other income earned, such as interest, dividends, or rental income. Each revenue stream is identified separately, providing a clear picture of the company's sources of income. In some cases, companies may also disclose revenue by product line, customer segment, or geographic region, offering additional insights into business performance. After total revenues have been determined, the cost of goods sold is calculated. COGS represents the direct costs associated with producing or acquiring the goods or services sold during the period. This typically includes raw materials, direct labor, and manufacturing overhead. The calculation of COGS may require adjustments for changes in inventory levels, as opening inventory and purchases are added together, and closing inventory is subtracted to arrive at the cost of goods sold. Accurate computation of COGS is essential, as it directly impacts the gross profit margin and overall profitability. The next step is to list and categorize operating expenses. These are the costs incurred in running the day-to-day operations of the business, excluding those directly related to production. Operating expenses are typically grouped into categories such as selling expenses, e.g., advertising, sales commissions, general and administrative expenses, e.g., office salaries, rent, insurance, and research and development expenses. Each expense category is itemized and totaled, allowing users to assess the company's cost structure and identify areas where efficiency improvements may be possible. Depreciation and amortization expenses are also included in the operating expenses section. Depreciation refers to the allocation of the cost of tangible fixed assets, such as buildings and equipment, over their useful lives. Amortization applies to intangible assets, such as patents or trademarks. These non-cash expenses reflect the gradual consumption of the economic benefits of long-term assets and are crucial for matching costs with the revenues they help generate. After deducting operating expenses from gross profit, the resulting figure is operating income, or EBIT. This measure highlights the profitability of the company's core business activities, excluding the effects of financing and taxation. Operating income is a key indicator of operational efficiency and is closely monitored by management and investors alike. The income statement then accounts for non-operating items, such as interest income, interest expense, gains or losses on the sale of assets, and other miscellaneous income or expenses. These items are reported separately from operating income to provide a clearer distinction between the results of ongoing business operations and the effects of ancillary activities. The final section of the income statement addresses income taxes. The company calculates its taxable income and applies the appropriate tax rates to determine the income tax expense for the period. Deferred tax assets and liabilities may also be recognized, reflecting timing differences between the recognition of income and expenses for accounting and tax purposes. After all revenues and expenses have been accounted for, the bottom line, net income or net loss, is determined. Net income represents the total profit earned by the company during the period, after all costs and taxes have been deducted from total revenues. This figure is of paramount importance, as it reflects the ultimate measure of the company's profitability and is often used as a basis for calculating dividends, reinvestment decisions, and performance bonuses. The preparation of the income statement does not end with the calculation of net income. Additional disclosures and notes may be required to provide context and clarity for users of the financial statements. For example, companies may explain significant changes in revenue or expense items, disclose accounting policies and estimates, or provide details of non-recurring transactions. These disclosures enhance the transparency and usefulness of the income statement, enabling stakeholders to make more informed decisions. Throughout the income statement preparation process, accountants must exercise professional judgment and maintain a commitment to ethical conduct. They must ensure that the financial data is presented fairly and objectively without bias or manipulation. This is especially important in situations where management incentives or external pressures may create temptations to distort financial results. Adherence to professional standards and codes of ethics is essential to safeguard the integrity of the income statement and maintain stakeholder confidence. In conclusion, the preparation of the income statement is a complex and dynamic process that lies at the heart of financial reporting and business management. It requires a thorough understanding of accounting principles, meticulous attention to detail, and a steadfast commitment to accuracy and transparency. The income statement not only provides a historical record of financial performance, but also serves as a vital tool for analysis, planning, and decision-making. As businesses navigate an increasingly complex and competitive environment, the role of the income statement in guiding strategy and fostering accountability will remain as important as ever. By upholding the highest standards of professionalism and integrity in the preparation of the income statement, accountants and financial managers contribute to the long-term success and sustainability of their organizations, building trust and creating value for all stakeholders.